Hi, everyone. This is Aaron Larson, executive editor of Power Magazine, and you're listening to the Power Podcast. On today's episode, I'm joined by Bala Nagarajan. Bala is the managing director of the energy investments team with S2G Investments. So, Bala, thank you for coming on the podcast with me, and please tell a little bit about yourself and S2G, please.
Of course. Firstly, thank you for having me, Aaron. Big fan of what you've done so far. Enjoy listening to your podcast and excited to be part of this podcast too. Personal background on myself: I grew up in the southern part of India. I'm an accountant for my sins. Worked in banking. Went to business school. I graduated and joined Lehman Brothers in 2008. 4 weeks before Lehman came down. At that point in time, I thought I was going to die alone and poor. Thankfully, neither happened. But that accidentally, and in hindsight, I'm very grateful for that, led me into the world of clean energy. I set up my own startup to build wind and solar projects in Europe. It didn't have the sort of the anticipated outcome, and taught me lessons on entrepreneurship, and that led me into the world of investing, where I think in hindsight, I'm a much better investor than an operator, and has given me a lot of empathy and sympathy to. I lead with empathy and sympathy to when we think about evaluating startups and entrepreneurs, because what they do is incredibly hard compared to what I do today. So I spent about 8 years at Equinor. Used to be called Statoil, a large Norwegian oil and gas company, but with a significant presence in the clean energy sector, particularly in offshore wind, and helped set up their clean energy ventures team initially in Europe and then moved to the States. And then more recently, prior to S2G, I worked at Nextera doing something similar, investing out of Nextera's balance sheet in venture growth equity firms in the clean energy utility sector. And I joined S2G about 2 years ago to co-lead our energy investments team.
Well, you've got a great background, and one of the things that I know S2G is involved in, as you mentioned, is investing in renewable energy. And a lot of the federal incentives have been changing. Tax credits are being phased out, some quickly, and loan programs have been evolving or changing. How do you go about evaluating your energy investments under this type of atmosphere and with this landscape and the fact that things can be changed and modified and repealed at any given time?
Yeah, good question, and this sort of makes our job incredibly hard, and to a much greater extent, makes the job of building companies in the sector incredibly hard. Having worked in these large energy corporates, conglomerates, I would say exactly what they would tell you, which is what they value is stability of regulations, stability in policy over, even sort of specific incentives. And I think that's what has been to some extent missing, particularly in the US in the recent years. But thankfully, we at S2G, when we think about investing in companies, we sort of we always tend to think about this from a standalone perspective. What I mean by that is the product or the solution sold by this business, is it cheaper, faster, better than the incumbent solution? Does that, if it's reliant on federal incentives, policy, whether policies that are enforced today, or if not policies that we hope to be enforced tomorrow, we tend to discount that heavily. So we invest on the merits of the business on a standalone basis rather than reliant on policy initiatives.
Mm-hmm. And I guess with that as a backdrop, what sort of things are looking most appealing to you at this moment in time with so much uncertainty and with now a war taking place in Iran and oil prices skyrocketing? What sort of things are appealing?
Yeah, sometimes the more things change, the more this some things remain the same too. So we're looking at sort of things that are what we call as anti-fragile businesses, product solutions that can withstand both geopolitical shocks and policy changes and potential sort of economic crises too. And I'll give you a concrete example of this. We invested in a business called Aerones. They have robots that can go up a wind tower and repair the blade of the wind turbine. Now, why do we think this business is anti-fragile? Because today these blades are being repaired by wind technicians, which is one of the most sort of sought after jobs, but hard to find. the right talent. It is one of the more well-paid jobs as well in the industry. But you can imagine why, because these sort of engineers and technicians, they're hanging off the top of the wind turbine and looking to repair these blades, which is a huge safety risk for them. But more importantly, the process is incredibly slow and not efficient. So Aerones came up with this robotic solution, which is able to go repair these blades of these turbines, which makes the whole process cheaper, faster, and better and safer. More importantly, and our investment thesis in Aerones is underwritten by the fact that we have an existing fleet of wind turbines that need repair, wind turbines that are today not being repaired from a preventative maintenance perspective because these technicians are incredibly hard to find. So by providing a solution which is cheaper, faster, and better, we think the industry would move faster in terms of servicing these turbines and therefore enabling the operators to produce more, and the ROI on the investment is incredibly better than sort of hiring technicians. So to answer your question, servicing wind turbines is going to stay the same. So we're thinking about the other asset classes, other subsectors within the energy sector where tech-enabled services are able to replace processes today that are more subject to inefficiencies and labor issues.
Mhm. And when you go into these types of evaluations, what does that due diligence process look like for you, specifically around power sector investments? And has that changed at all in recent history, in the past 3 to 5 years, or have you always maintained kind of a consistent process?
Yeah, and I can speak to my personal history of working in the energy sector, power sector more broadly, and also investing in the space over the last 17 years. I think when I started out in this industry, it wasn't entirely obvious, where energy transition would eventually lead to. These were early days in the 2000, sort of early 2000s to mid 2000s, where there was significant government incentives and policy sort of help that was enabling the transition. And at that point in time, the risk was, will this policy go away? What happens? Will banks continue to fund this? Will investors be around? If you're investing in a series A, B, C round of a company, you weren't really sure who was going to come after you. Whereas I think that risk is significantly come down in the last sort of 5 years or so, 5 to 10 years, I would say, because we've seen incredibly deep pools of capital come into the energy sector in particular to back the energy transition related investments. So the risk of who is going to invest after you is far less now than before. The other element to this is, especially with the advent of AI, and I'm very grateful that AI requires power and not copper. If it was copper, you wouldn't be talking to me. You might be talking to somebody who's in the mining industry about this. But what that means is the advent of AI has resulted in there is a premise that power prices will stay higher for longer. And I think this has never been the case before. Much of my career in the energy sector, we've seen, especially sort of wind, solar prices come down, then go up over time. We've seen interest rates being incredibly low for much of those last 15 years or so. Whereas now we are at that point in time where power prices are going up, interest rates have evened out, if not maybe potentially coming down, subject to sort of the geopolitical shocks that are coming through. And we have a demand for energy which is both near term and in meaningfully large size. What I mean by this is we've always known electrification will add to more demand for electrons, electrification of homes, electrification of transportation, and potentially the hard to abate sectors. But we always knew that was going to take time because transitions take time. Whereas with the advent of AI, data center build out, which is happening near term, that demand is knocking on our doors today, then being spread out over the next 10 years, which has resulted in demand for higher electrons, demand for power, more broadly speaking, which makes investing in the energy sector incredibly interesting because you have demand on one hand, which is going up, supply, which is relatively constrained, and macro factors such as interest rates and policy being relatively benign. So we're able to sort of use all of these as lenses to evaluate whether an investment will hold up in the context of sort of these changes.
Mhm. And of course, you mentioned how AI is affecting the market and how it had such an increase in demand because of it. Are you using it at all in your models or in your investment schemes to find good investments and to evaluate the investments before you jump in?
Do you mean, do I use AI with respect to sort of evaluating potential investments, or am I factoring in AI demand in the growth prospects of businesses we look at?
Yeah, I'm thinking more of in terms of you using it in models that you're for your own purposes for evaluating things rather than just about the demand.
Yeah, I mean, our team is figuring out the power of Claude when we look at financial models that sort of we put together, and when we get from companies that we're evaluating. We've also used tools that are helping us sift through data rooms. When we look at companies, we get access to thousands of documents. As much as it behooves us to look through every single document, there are limitations of a small deal team that we have here. So using AI tools has helped us come up with a red flag report, which is super helpful with respect to prioritizing resources and time on the most critical issues, and also enabling us to process and evaluate deals in a much faster pace.
Mhm. When you look at the risks that are out there today, we talked about some of the things such as geopolitical risks, wars and fighting. There's price regulatory issues, there's permitting risks. What are you most concerned with, or what do you see as the highest risks when it comes to investing in power infrastructure and power investments?
I mean, my personal view here is that there is a presumption in the industry that power prices are going to be higher and will stay higher for a much longer time. As you know, much of the power infrastructure which is put to work, whether it's wind, solar storage, or even gas power plants and coal power plants, they're all built for 20 years, if not potentially 40 years. And it's incredibly naive to some extent to believe what we see here today will remain the same for the next 20, 40 years. Hence, we prefer to take a more skeptical view of what if things change, and how well will our underwrite hold up in the midst of potential changes within our hold period, and more importantly, beyond that too. So I would say the biggest risk that we see here is the enthusiasm and more importantly the signals we're seeing from the market in terms of higher capacity prices and power prices, and us needing to be a little bit more skeptical about the duration of those prices staying where they are today, and if not potentially going down or up from there.
And when you look at the different types of technology, whether we're talking about power generation or grid technologies, what's attracting the most interest right now, and which types of technology are struggling to secure financing?
I think this goes back to what we discussed before, which is if you have higher power prices, any product where you're relying on low power prices to make something becomes more challenging. What I mean by this is if you're producing hydrogen from clean energy, unfortunately, clean energy prices have gone up significantly, which means that the end product, which is green hydrogen here, will be more expensive. So this is similar with respect to sustainable aviation fuel, similar to sort of other hot or bait sectors who are trying to replace incumbent solutions with clean electrons. So I would say the sector that's unfortunately struggling the most is what I would bracket and call as power to X, where you're using clean power to produce another product. There was incredible enthusiasm around the sector maybe 5 years ago, combination of low power prices and policy support. Unfortunately, both to some extent have turned against this subsector meaningfully, and hence capital flows have been challenged. Where I'm seeing significant interest is conversely around, how do we enhance and make better use of the grid that we have today rather than having to build additional capacity. So any technology product around the grid in particular, whether it's grid enhancing technologies, conductors, all things related to making the existing infrastructure better is resonating strongly with investors. I would say sort of we've seen a significant amount of capital flow into the solid state transformer space. Most of these companies are relatively early, but the promise of eventually moving to moving to solid state transformers and the benefits that they bring have attracted sort of incremental sort of capital into that particular subsector as well.
And we've already talked a lot about data centers and the demand that they're bringing, but how does data center demand factor into your energy investment calculus and how you make decisions?
Yeah, I think we're still in the early innings of seeing this play out. There is certainly strong interest, commitments from the hyperscalers in terms of procuring additional energy. It's been a very long time since I saw big tech acquiring a DevCo platform in our space. You saw Google acquire Intersect. That's the sort of reference that I make here. So clearly, there is a significant convergence between the priorities of big tech and the need for incremental energy. How are we factoring for this in our investments? I think higher power, if there is an incremental buyer here, which is big tech, who are relatively price insensitive, you're seeing that in the price signals, which is what we talked about before, which is higher power prices, higher capacity prices. I think our investment thesis around this is to not necessarily bet on that wave, but think about who's most impacted by that and how can we back companies and technologies that can help alleviate some of the concerns around affordability, some of the concerns about higher energy bills going forward. So if that demand stays consistent and grows, I think every single residential customer across North America will be calling up their utility to find out why have the bills gone up. Not just the Fortune 50 or the 500, but every small commercial industrial customer will need help to manage their energy bills and reduce their energy bills. So there might be interest in solutions that will help them switch providers, interest in solutions that are delivering energy efficient solutions, whether it's insulation, whether it's behind the meter, rooftop solar, battery storage. All of this helps make those businesses resilient because until now, electricity bills were not high on their priority list or risks register. Whereas with increasing power prices, that calls into question the viability of many businesses, unfortunately, and therefore people need more help. And we're backing businesses that can help at a time when they have very little control on their energy costs.
For these capital intensive projects, when we think about generation or storage projects, what's making certain deals pencil out today versus what may not be working or might be stalling in the queue?
I would say permitting reform to some extent. What I mean by this is if you're building a wind project, as an example, you would have found a site, you'd have gone through an interconnection planning permit, local community engagement process over the last sort of 5+ years. And suddenly you have changes in permitting sort of policy. As a consequence, the underlying risk of these projects have gone up, the cost of capital for these projects have gone up. And then there is also, I think we touched on this before, there is an impending sort of tax credit policy change that is coming through. And what happens to projects that don't meet that deadline and have to get pushed out by a quarter, if not by a year, where those tax credits are no longer eligible? How would those projects pencil out with lack of tax credit support? Those are the sort of key risks that I think, in particular, wind, but increasingly many of the power generation projects linked to policy support are going through.
Mhm. Do you see there being more money available for projects, or is it more selective in who's being funded and how they're getting built?
Yeah, it's a good question. We've been from our prior fund, we've invested in platforms that are building community solar projects and utility scale wind solar projects. One of the sort of impacts of the policy changes, in particular the tax credit policy changes, has been that only the well capitalized developers have been able to leverage their balance sheet in particular to safe harbor equipment, which will help them extend the tax credit incentives that are available. Whereas if you're a small developer without access to capital, you won't be able to safe harbor, which puts you at a significant disadvantage. So we've seen capital flock towards the more established, well capitalized players, and the ones that don't have access to capital struggling to execute on projects, if not being forced to sell projects to the more well capitalized players. Hence, I would say the flight of capital is more towards trusted brands than towards sort of nimbler organizations, which previously had an unfair advantage.
Mhm. Well, this has really been interesting, Bala. I appreciate your time and providing your insight. Is there anything that we haven't talked about that you think is important to touch on before we wrap up?
No, I think we couldn't have ended a conversation without talking about AI and data center demand, which I think we touched on at significant length. We're also seeing for many years now, we've been talking about software and how software in particular for the more sort of incumbent utilities and power producers would be super helpful. Vertical SaaS software in the public markets are going through a period of significant correction. We're seeing some of that trickle into the energy sector too. So from an investment perspective, with reference to your earlier question on which sectors are getting capital and not getting capital, I think the software sector is certainly seeing investors are pausing rather than rushing in to invest in the sector to some extent. I'm also a big believer in the fact that the energy markets are going to use gas. 10 years ago, gas was called a bridge fuel. Now, I don't think anybody would sort of say it's a bridge fuel. It's here to stay for much longer, given the amount of gas turbine demand we're seeing from hyperscalers and sort of what we're hearing from the likes of GE and Siemens. A consequence of higher usage of gas in the energy markets is that our emissions are going to go up. So I personally believe there is going to be a significant demand for high integrity carbon credits, a sector which again has gone through its own ups and downs. I am extremely bullish on the prospects for high integrity carbon credits, and hopefully we're evaluating a few companies in the space and hope to make investments in the space too.
All right. Well, thanks again, Bala. Again, for listeners, I've been speaking with Bala Nagarajan. He is the managing director of the energy investments team with S2G Investments. It's been a pleasure having you on the program.
Likewise, Adam. Thank you.